In this video, I'm gonna walk you through how I value my stocks. I'm not a financial advisor. I'm just here to share you with my knowledge that I deem to be important in my investing journey, and I hope that it could help you as well. I have a work principle that I walk through every one of my stocks every 3 months, and I make a new valuation just to make sure that it still fits the picture and that I still would like to hold my equity in the stock. So the name of the game is return. It's when the money works for you. It's this beautiful thing of putting your money at a place A, wait a couple of months, take it out, and it's worth more than when you put it there. You can accomplish this in several ways. You can buy your own property, you can buy something on Facebook Marketplace, buy it cheap, sell it for a bit more, and you will gain a profit from that sale. That is a return on your cash. You know, it's all the same thing. It's a yield, rate of return, profits on your investments. With stocks, it requires much less from you. Like, it's very simple if you compare it to buying things on Craigslist or going out on a garage sale. You can just buy a stock, let a financial house hold it for you, keep it there, and then after a couple of years, hopefully it has gained in value. In that regard, it's very simple. On the other hand, stocks and other assets like it are considered to be of higher risk. But usually this risk is related to people going into the stock market and buying other things on the market, and they are way underprepared. They are way undereducated, and they do not know what they bought, and they do not know what to buy. They have no clue what they're doing. And when you're entering the stock market, or any other market for that matter, with that type of knowledge, you are very likely to lose money. Because a lot of the times people are entering the market with a sense of FOMO. They've just heard a lot of people, and there's a lot of talk about the stock market, people making a lot of cash everywhere, and they're entering the market, and unfortunately a lot of the times they're entering the market when it got a big hype. And then you're maybe up for a period of lower stock values, and you buy stuff that people recommend that is already way too overhyped, and you might lose a big chunk of your cash. And I'm sure you heard of a lot of people that gone into the stock market and lost a lot of money, but I'm also sure that you've heard about a lot of people that gone into the market and made a lot of money year over year. So what's the difference between these two people? The biggest difference is that the one person that makes money year over year, they actually know a little bit about what they buy, and they have a little bit of strategy. This is not rocket science, like it's not that complicated, but the biggest difference is that you have to have a little knowledge of what kind of stocks you're buying, what the value of those stocks are before you buy them. So you actually have your own strategy without being in this roller coaster of a stock market and just ending up losing a lot or some money. So what should we do to get rich on stocks? We teach ourselves how to value the stocks. Okay, that is the secret recipe. And that's exactly what I will walk you through in this video. I will show you how I value stocks. I've been in the stock market for 7 years, and I've managed to have a rate of return of 18% over these 7 years. And this is just a video to show you how I value stocks, and hopefully it will help someone, or at least it will cement the knowledge in my brain, hopefully, because I deem this knowledge to be very important. But I do repetition it all the time. I read over my notes, I read the books again, and I go over my strategies all the time. Because you forget, then it's not as fun anymore, and you don't do it as often, you just lose routine. So you have to repeat it all the time in order for you to not lose focus. I will show you how you can do these valuations yourself. It's very simple. Me personally, I sit in 8 stocks. 8 stocks, okay? And every 3rd month, I do a new valuation in order for me to see one of 2 things. Either has the stock gone to the moon and gone into overhyped territory, or has the stock finally entered some kind of fair valuation territory, because the parabolic stock rise could be motivated, but it's just motivated if you yourself have a plan and a thought process of where the company should be. Because if you don't have your own valuation thesis, all these ups and downs in the market will kick you out in no time. So as I said, either the stock has gone too good or really good, so you have to make a new valuation, feel yourself in the stomach, make a new feel for the stock to see if you're gonna hold the stock or sell the stock. Or secondly, has the stock underperformed the market, and how's the leadership sounding? Are they confident? Are they spooked? When the analysts are asking them questions, do they seem fearful Or do you get a bad feeling about the stock? So it's very important to distance yourself a bit from the stock, because a loser mentality is the one that sits in the stock all the way down to the deep end of a stock valuation. That's not a smart thing. You need to value your stock over the year, not all the time, but a couple of times. I do it myself at least 4 times a year to once again make a decision, because your money is on the stock and you continuously have to make a decision if you were to stay put on your stock, or if you get a bad feeling and the stock has underperformed, the leadership ain't performing as they said that they would, according to previous calls, their numbers ain't coming in as they should, maybe you should drop it. Okay? Stocks a lot of the times feel like a lot of work, and it can feel troublesome. And maybe the first thing we do is that we start to look at a stock channel on TV, or we start to read stock news like Barron's or some other stock news outlet. I deem that to be a waste of time. It can be good in order for you to have a feel on the market, but regarding your stocks, a lot of the information and news out there, it has nothing to do with your stocks. Nothing. It has nothing to do with your companies. A lot of the times the stock news outlets can make you feel worrisome when there's nothing to worry about in your stock. So the most important thing is to have a thesis behind your stock and read up on the stock, the leadership. Make sure you dedicate some time to follow up on your stock over the year. And once again, in order for you to look past all this blur that's going through all the news outlets and so forth, you have to have your own valuation strategy in order for you to stay cool, stay put, and know why you're holding your company as you do, and know what the stock probably should be at in a couple of years. That is the only information that is important. So, what you would look at? You all probably know about the most popular stocks: Apple, Tesla, Google, Microsoft, and so forth. And some of these popular ones can be really good investments, even to this day. We're at 15th of November 2023. But when you Google about the company and you're gonna start with this valuation process, what is it that you're gonna look for? Generally, it's only 3 things that's important. Firstly, is the company growing? And is the company getting bigger and better for every year that's going by? Secondly, is the company handled well? Does it have a good leadership? Does it have a good CEO? And thirdly, what is the company selling for? What's its valuation at? At what price are you able to buy the company for now? Because no matter how good a company is, you're not going to pay any amount for that company. That's not how it works. It's not like you're going to buy something that you know that you can buy for a lot less, that you're going to overpay for something that's very similar. At what price is the company selling for based on how it's performed and how its future prospects are looking? Because no matter how good a company is or looks, it's not worth everything. For that reason, it's not worth your time and money. You have to make your own choice, your own valuation to see if it's really worth your own hard-worked money. So these 3 things, it's majorly the things that we as shareholders make money on. So how can we tell if a company is growing and getting better for every year that's passing? There's a lot of different ways that you can analyze this, and as time goes and you get better at this, you can come up with even more creative and smart ways to theorize and actually come up with ways to measure this. In this video, we're gonna keep it very, very simple, and we're gonna look at one value in particular, and that is book value per share. It's a value that's comprised of a company's total assets minus its debts. Every asset that the company have, let's say you're gonna invest in a coffee shop, and the coffee shop has a really expensive coffee maker. This coffee maker is actually making this cafe cash, hand over fist, because you as a customer come there and you pay a very expensive price for the coffee every day, but you love this coffee. So this machine is a really good asset for the coffee shop. So this asset is included in the company's books as an asset. Another thing that can be an asset is cash at hand. They have cash in their balance account, or it can be goods that they are not sold off yet. So let's say this coffee shop has a lot of coffee beans that they will be able to sell. That will be booked up as an inventory, and it will be able to sell off for cash later on. So it's still a very good asset for the company. So book value is all the company's assets minus all its debts. Generally, this measurement, the book value, is hardest to manipulate. So that is why we're gonna look closer at this value, because it will be important when we set our final value on what the company should be priced at. So the other thing about the company having a good leadership, once you find the company that you want to deep dive a little bit inside of, you just take the company's name and you search for the company name and investor relations. You Google that and you will directly find the company's own investor relations website. In there, they will have a brief presentation of the company as a whole, and they will have the latest quarterly conference calls where you can sit there, listen in on the leadership when they talk about their prior results, and also listen to the analyst's question to the leadership. That is a perfect way in order for you to see how transparent the leadership are, because the analysts, they're people much smarter than you and me, and they're getting paid a whole lot of money in order for them to do a good job about analyzing companies. You can see it as listen in on this call where a lot of smart people are asking this leadership about their company, and if there's some shady things going on, you can a lot of the times catch it when you listen into the conference calls. So listen up on a few conference calls, make some notes about who the leaderships are, and Google on the CEO, do some deep dive to that guy, make sure that he sounds like a guy that you can trust on. What has he been doing before? How long has he been CEO at this company right now? Do you get a good feel of them? Do you get a good feel of the CEO? What is the company selling for? A lot of the times when you start out, you hear about all these companies and maybe you know some friends that made a lot of money on some stocks, and you go in and you look on the stocks and you look on the stocks that they maybe recommended, and a lot of the times it can be stocks that have been doing really well, and a lot of the times these companies continue to do well, or a lot of the times you're just up on the hype territory on this stock and the stock is going straight down the pipe. So what's important there is that you don't feel demoralized when you look on these stocks that people made a lot of money on, because there are tens of thousands noted stocks that you can pick from. So, and there's thousands of them that will make you a lot of money over the years to come. The most important thing is that you gain a framework for how to actually value these companies, so you can have some clarity when you see these stocks. Okay, that's the most important thing. So, how do we know if the stock is overvalued? Now when we have a little sense on what's important and not, we're gonna walk you through the calculation on what makes the company worth to buy or not. So, besides the book value share growth that we're gonna pick out in a couple of minutes, the other value that we need to have is to see how good the company has been on their earnings per share growth over the years. So practically how good they have been on increasing their profits over the years. Generally, we would like to have 10 years of historic data on a company, and there is so much companies out there that has done such a great job, so this is not an issue. And a lot of the times we maybe have some companies that doesn't have 10-year history. I recommend you, if you're new to this, that you at least have 10 years of history. If you really want to check out the valuation of a company that has less history, you can do that as well. And this way of evaluating companies works even if you have just a few years of history. Let us say if we're gonna value an American company called Sprouts. It's an American food chain that specializes in organic food and local grown stuff. I use two websites to check up on company data. I use quickfs.net and the other one is stockrow.com. So we're gonna start with quickfs.net. Quickfs.net. It's a really good website that's very clean and simple to use. So you go up here, and the Sprouts that we're going to look at has a ticker name that all the stocks have, and Sprouts are SFM. Sprouts. The values that we're going to look at are earnings per share at this stage. So we have earnings per share there, 2013, $0.37. And over 10 years, it managed to increase its profits to $2.39 in 2022. So 2013, $0.37, $2.39 in 2022. So now we need to calculate the growth rate that this had over these 10 years. There's a very simple way to calculate this, and it's a thing that's called the Rule of 72. The Rule of 72 is a tool where if you manage to calculate how many years it takes for a company to double its value, in this case its profits, we can take 72 divided by that value, and the answer from that calculation will be the percentage that the company grows with every year. And in order for us to know this, we're going to calculate how many times it doubled over these 10 years. That's the first thing we do. So in order for us to do that simply, we round the first number up. So we take 0.4 times 2. That's 0.8. 0.8 times 2. That's 1.6. And 1.6 times 2, that is 3.2. And as we can see here, 3.2, that is, so we don't have 3 doubles. We have way more than 2 doubles. So let's say we have 2.5 doubles. So over 10 years, we had 2.5 doubles. So in order for us to calculate how many years this company needs in order for it to double once, we take 10 divided by 2.5, which equals 4. Okay, so 4. Now we know that this company needs 4 years in order for it to double its profits once. So in order for us to get a growth rate out of this, a percentile out of this, we take 72 divided by 4. And we have a number, which is 18%. So over 10 years, it managed to hold up a number of 18% of earnings per share growth. That's great. And that value we will need when we make our future calculation of the stock price. And the lesser the years, the higher the percentage growth rate will be. So let's say if the company only needed 3 years in order for it to double its profits, we would end up with a 24% growth rate. If it only needs 2 years, we would end up in a 36% growth rate. So the name of the game is to find out how many years the company needs in order for it to double its profits once. You divide 72 by that number and you will get the growth rate number. Play around with this. The rule of 72 is a great tool in order for us to quickly get a sense of how large are the growth rates and how under/overpriced is this stock. The other number that we need in order for us to make a valuation of the stock is book value per share growth. In order for us to get that number, we're going to use their second website, which is stockrow.com. So we open up a new tab, type in stockrow.com. And of course, during the production of this video, this site has now been a paid version, which happens a lot with these sites. So I found another one, which is, if you go up to the search bar and type stockanalysis.com, you can put in your ticker here, go to financials, balance sheet, and then you can scroll all the way down here. You have book value per share, and you got 10 years of data. So just follow along on this site instead, and you will be fine. Up here, we type in SFM, Sprouts Farmers Markets, and we go down here, book value per share. 2013, we have our input number, $3.82. And over at 2022, we have $9.67. Now, how many doubles do we have here? 3.82 times 2. That's 7.64. And 7.64 times 2. That's 15.28. That's not where we're at, but we're definitely not at 1 double. So let's say we're at 1.5 double. We know that the company doubled its book value by 1.5 times in 10 years. So then we take 10 divided by 1.5, which is 6.66 or 6.6. So then we know that it takes the company 6.6 years in order for it to double its book value. In order for us to get a percentage out of that, we take 72 divided by 6.6. And we get 10.9. We round that number up to 11. This number is the number that we're going to use when we put the actual valuation on the company's profits. The higher the company is able to grow its book value, the higher the valuation we can put on it. So it goes both ways. So in this case, we have 11%. And the strategy is that we can put the growth value percentile times 2 as a valuation on the stock. So we take that times 2, that's 22. That would be our motivated future PE, okay? The price per earnings. The most popular way to evaluate a company is to set a price on its earnings. And we're gonna use it as well in our valuation process. So now we have earnings per share growth, we have book value per share growth. We only need one other number in order for us to make a complete valuation. And that is how many shares the company actually have. In order for us to get that number, we go back to QuickFS and we're gonna look up here to 10K or 10Q. The 10K is the company's latest yearly report. The 10Q is the company's latest quarterly report. And what we're gonna look for is the latest one. So we open up both of them and we're gonna see which one of them that came in latest. And here at the 10K, you can see the latest one is 2023-03-02. And at the quarterly one, we have 2023-10-31. So it's by a good margin, the latest one. So we're gonna pick the 10Q and we press documents. And we go over here to SFM, the one that it's IXBRL over here. We press that one. And here's the latest company's quarterly report. And to get the latest shares outstanding number, we press Ctrl F and we type shares. And then we have the shares right here. So 101,560,802. 101,561,802. Okay. Now we're gonna project our future valuation on the stock. So what we're gonna do now is we're gonna count on what the company's value should be in 10 years time. What we do then is we take the latest earnings per share value, add the earnings per share value growth percentile that we got earlier, the 18%, we add that 10 times to that number in order for us to project a future earnings on the company 10 years from now. As we could see on the QuickFS, the latest earnings is $2.39. So we take up our calculator and we type 2.39 times 1.18 and we type it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And we have a future earnings per share number. So if the company is able to withhold its 18 percentile number on its earnings, it will in 10 years time have earnings of $12.51 per share. Then we multiply that with the number of shares, which is 101,560,802. And we get a huge number. This is the actual dollar value that the company should be worth if you were to buy the company of a PE of 1. Okay? We're gonna add our multiple of 22 that we got from our book value share growth over here. But before we do that, we're gonna simplify this number a little bit and divide it by 1 million because we want to know the value in millions. That will be easier to count. So we divide this number by 1 million and we get 1.27 billions. Okay, so $1.27 billion. Then we will add our valuation. So we multiply this with 22 and we get a valuation of 27.9 billion, almost 28 billion. So this is what the stock should be at in 10 years time if the company continues to have a earnings per share growth of 18%. So what's the company selling for right now? It's selling for 4 billion. That is a lot of growth. So we have 28 billion divided by 4. That is a 7x if everything goes well. This is a valuation that it should be at in 10 years time if it managed to withhold its 18% earnings per share growth, okay? What should we pay for this stock right now? Because in order for us to have a clear picture of what the value of the stock should be right now, we have to add something that is called minimum acceptable return. And that is due to the fact that just because we find stuff that should be worth more than what it is when we put the money in the first place, we still have to have proper demands on how much rate of return we should expect on our investment. So the higher the percentile you put as a demand for your money, the less you would like to pay for the stock. The lower percentile of return you're able to take on your money, the higher the price you can motivate yourself to pay for the asset. So it's about being greedy here, but not too greedy. Because if you're too greedy, you're just going to think that the really high risky assets are flashy enough. And at the same time, if you have a too low percentile, you're just being stupid about your money. So the percentile that I put on my valuations is 15%. And 15% also make this valuation process a lot simpler, because you just take your future valuation that we just set here, 28 billion, rounded number, and you divide it by 4. Okay, so you take 28, you divide it by 4, and then you get a number of 7 billion. This company should be worth 7 billion, considering that we have a minimum acceptable return of 15% over 10 years. 15% on your cash, that's not bad. That's not bad at all. Set minimum acceptable return of 15% by dividing it into 4. So 28 divided by 4 is 7. So 7 billion, this company should be worth 7 billion, considering that your minimum acceptable return is set to 15%. Now, generally, we do not want to pay 7. We also want to have a margin of safety, which is your safety net in order for you to feel really safe on the stock that you're holding in. Because this stock should be worth 7 billion. So everything that you pay less than 7 billion, that's great. But goal-wise, we should aim for having a 50% margin of safety. So in our case, generally, we would like to pay 7 divided by 2. To set a 50% margin of safety, you ideally want to pay 3.5 billion. Now the company sells for 4.1. That's 17% off from what a 50% margin on the stock would be. A few other things that's very important when you look at the stocks that you might be interested in putting cash in is look on the return on invested capital. Its values should be over 10%. Elsewise, it's probably something shady going on with the business. So you just go into QuickFS and you look on return on invested capital, and these should be over 10%. Another thing that's very important is that the company is actually growing. So what do I mean by that? Now we look at profits and we look at book value per share growth. These are the two quickest numbers and best numbers to look at. But when you're gonna look deeper into the company and actually put some money inside of it, you also want to make sure the company is actually growing. So in this case, you have 2022, 6.4 billion, 2021, 6.1, 2020, 6.5, 2019, 5.6, 2018, 5.2. So the company is actually growing. Okay, that is important. Another thing that I deem to be an important rule is to not invest in companies that's valued under $100 million. That is a rule of thumb that I try to use. And a great site in order for you to screen stocks and find stocks is a site called finwiz.com. It's totally free and very, very simple. And you can go here to Screener, and you can use a whole lot of different dataset tools here. You can use the industry, and there's a lot of different industries here: country, IPO date, market cap. In here is a perfect website in order for you to find new stocks. This strategy is taken from Phil Towns and his Rule 1 investing strategy. Phil Town has written 2 books. The first book is called The Rule 1 Investing, and the other one is called Payback Time. These are great books, and he's also written a third book with his daughter Danielle Town. These are all great books. I've read his first 2 books like 3 times, and I read them once in a while to repeat and cement all the good information that he is putting out there. What's great about his books that they really give you a practical way of thinking that you really can use yourself in order for you to get your own mindset on these stocks, and most importantly, in order for you to actually be able to evaluate these stocks yourself, so you become an independent thinker in this space. It's very important in order for you to last in here, because sometimes it can get rough. But it doesn't have to be. If you have your own valuation strategy and you actually know a thing or two about the stocks you're buying, you will be 99% better than everyone out there, because that is the only way in order for you to stay cool when the market drops 40%. So that is a video on how I value stocks. I hope you found some value in this. If you have any questions or have any suggestions, feedback, you can put them down in the comments. So thanks for watching. Please leave a like if you thought it was helpful, and subscribe if you want to get notified about future videos. Elsewise, you have a great day, good luck with your stuff, and have a good one.